Good evening, ladies and gentlemen. This is Barry Norman on behalf of ETX Capital, and welcome to our class on trend trading. Now, ETX is a regulated provider, so I'm therefore required to give you a risk warning. Trading in the financial markets can result in the loss of the amount invested. Do not trade with funds that you cannot afford to lose, and seek advice if you do not understand the risk. All information is provided in this webinar is for educational purposes only. ETX Capital and the presenter are not financial or investment advisors, and we do not recommend any securities or instruments. Anything we talk about tonight is for educational purposes only. Now, for those of you that are not that familiar with us, ETX is a fast-growing financial services company, and we are based in London. We are authorized and regulated by the FCA, that's the Financial Conduct Authority, and Monocor, who is our parent company, is a member firm of the London Stock Exchange. So you know you're dealing with a large, well-known company. Your funds are protected because your funds are all monitored by the Financial Conduct Authority and segregated into safe accounts. Now, when you trade with us, we offer many different trading platforms, and you can use one of them, all of them. You can jump from one to the other. It's all the way up to you. If you're a new trader, you might want to start trading with our ETX binary, only because binary options has limited risk, because whatever dollar amount you type in the screen is the only risk you have. And your profit is predetermined, and you're simply predicting whether an asset will move up or down from the price offered. If you want something a little bit more advanced, or once you start with the ETX binary platform, you kind of understand how assets move and how prices move, and you kind of get a better handle on the market, you can move over to our ETX Trader Pro, which is our web-based trading platform for CFD, spread betting, for Forex trading, commodities trading, stocks and indices, and you can use our online version of our Trader Pro by simply logging in and trading right there on the screen. You'll get our very advanced charts. You'll be able to do all kinds of order entries, and you'll be able to customize your trading experience. And for those of you that want the ultimate in trading, you can download our ETX MT4 platform, which allowed you to add on expert advisors, as well as automate some parts of your trading. And it's completely up to you. You can use all of them, none of them, one of them, whatever is best for you. Now, tonight's class is being recorded. You can access the recorded version of this in about 24 hours using the same link you came to tonight's class with. So let's talk about following the trends and incorporating this into your trading decisions. Trend following is perhaps the most popular long-term strategy in all financial markets. As a trading strategy, it is exceedingly effective and profitable when the conditions are favorable. It is quite straightforward in its methodology, and there are many individuals, past and present, famous and obscure, who have used this strategy to success and riches. We should note that the technical aspects of trend following is in fact quite simple, but it also requires that before anything else, you use discipline, sound money management, and patience. Now remember, not all strategies work for everybody, and you have as much loss or risk of loss as you do of making profit. But you can reduce those risks by using proper risk management and money management skills, because whenever you can reduce your risk, you can magnify your profits, because when you make a profit, you have less losses to cover, and so you'll end up with a larger net profit. So trading risk is the most important thing anybody can do. Now, trend following is not a short-term method, and patience and determination are as important as the correct analysis as a result. Now, trends are created by powerful underlying economic factors, which may not be clear to those who are not very familiar with fundamental analysis. But the simple patterns created by price action in response to the economic events can often be identified through methods that are easy to learn and apply. Thus, the retail trader has much potential of success as the experienced analyst if he can control his emotions and behave logically. Now, to apply the strategy, we must first be aware of the existence of a trend. Without identifying a trend, we would just be gambling. And that's not the purpose of trading Forex or CFD trading. Both fundamental and technical analysis can be employed for identifying a trend, and both of them have their advantages and drawbacks. It is, in general, a good idea to use a combination of them for deciding on the trend's character and deciding on our entry and exit points. Now, the first thing we have to know is, how do we identify a trend? And identifying a trend is different than drawing a trend line. Drawing trend lines have very strict rules. Trends also have rules to help us interpret whether it's a weak trend, a strong trend, if it's a well-established trend, or a tradable trend. So the first is general observation. We want to observe the market swing points, and it's the first point of call in determining if the market is trending. If you do not see a pattern of higher highs, higher lows, or lower highs and lower lows, but instead you see sideways movement with obvious no general up or down direction to it, then you are probably looking at a range-bound market or one that is simply chomping back and forth. So what we mean is, in the red pattern here, red trend, what we're doing is, each time the market moves up, we create a higher high. Then a good market will then ease back down and then push back up, because the market moves in push and thrust. Thrust and ease, or peaks and valleys, however you want to describe it. But the more well-defined a trend, the more you see these. And what you do is you start moving in an uptrend and you create a higher high. Then the markets will ease back to a lower high, a lower low, and then we'll push up to a higher high, ease back down to a lower. And if you notice, every time it creates the new low, it never breaks below where the low was in previous. Each high is a higher point than the previous high. And this gives you a very well-defined uptrend. In a downtrend, you're looking for a higher low, then, a lower low, then a higher low, a lower low, and then a higher low. Again, the same formation, just the reverse of the flip over. So you have lower lows and lower highs and lower lows. Lower high or higher high simply means the price. If the asset was trading here, say that was 0, it would push up to, say, 2. This is that level, hypothetically. Okay. Then it would ease back down to 1. Once it eases to 1, we would never expect it to come as low as 1 again. We would expect it then to push above the higher high it made, and then make a 4. Ease back down to a 3, and then push back up to a 5. Ease back down to a 4. Come down to a 3, move up to a 5, come down to a 4, and then move back down. Now, these numbers are just hypothetical. That's not a mathematical statistic. But this is what a lower low is, or a lower high, and a higher low. And the more well-constructed a trend is, the easier it is to trade that trend. You can have weak trends or sloppy trends. Okay. Now, what we're looking at here in this picture is a textbook perfect trend line. But you could get a trend that moved this way. You could get a trend that doesn't have as steep a variation between all the lows and the highs. But there are some rules about which point or which thrust will be stronger. Again, the more well-defined the trend, the easier it is to trade that trend. So what you want to do is, we talked about, observe. And we want to look for higher highs and higher lows, or lower highs and lower lows, depending on whether we have an uptrend or a downtrend. Now, you shouldn't have to think too hard about whether a market is trending or not. You should be able to see it very easily. Most traders make trend discovery way too difficult. If you take a common sense and patient approach, it's usually fairly obvious if a market is trending, or not just by looking at the raw price action of its chart from left to right. Make sure you mark swing points on your chart, as it will draw your attention to them and help you see if a pattern of higher highs and higher lows, or lower highs and lower lows, as discussed. Now, so remember, in an uptrend, the market rises and makes subsequent higher highs and then higher lows. In a downtrend, it's again the opposite. Now, it sounds like, why are we reiterating this over and over? When you want to trade or trend trade, you've got to find an asset. You don't care which asset. You want to find assets that are trading in well-defined trends. I mean, a perfect example of a well-defined uptrend would have been trading Bitcoin over the last month. I mean, not only did it have a hard rally, it was trading in a beautiful, perfect uptrend. Okay. Now, technicals are more important. No, fundamentals are. You can use either in trend trading because you're less concerned with the other technical analysis and the fundamentals analysis. You're more concerned with the development of the trend. Now remember, fundamental analysis is trading using news and headlines, economic events, where technical analysis is trading with patterns on your charts, as well as indicators and oscillators or mathematical calculations that are placed on your charts. Now, the question is, how do I decide on the existence of a trend? There are many technical tools that can signal the phenomena, but there are an equal number of false signals generated by them. Remember that there are only three kinds of trends that can exist at any time: flat or sideways changes, up or down. That's it. So you have assets moving congested to the side or up and down. Now, to see a trend from the beginning, we want to see it create a new high. Then it's going to dip down to a low, and then when the next thrust pushes above the most recent high, then we can say, or at that point, that we have the beginnings of an uptrend. We want to confirm that by the next wave or the next movement. After it meets this, breaks that point, it forms this new high, makes another low, and then forms upward, giving us a confirmation of that trend. Again, the opposite is true of a downtrend. So simply take two random points on a chart, drawing moving average on them, and the pattern that arises can be analyzed as a trend. Thus, it is always necessary to have at least a basic understanding of economic factors that can create trends before deciding on the validity of a chart pattern. Now, the trend that we seek to trade is different from random fluctuations, range patterns, and similar price movements in the price itself, in the absence of any technical indicators, can still be recognized as showing a trend. Now, if you notice here, we see a well-developed downtrend. Why? We see ease, thrust, ease, thrust, ease, thrust, ease, thrust, ease, thrust. Now, it's not as pretty as that line that I showed you in the beginning, but in reality, this is what it looks like in our charts, because we're never going to see a perfect drawing, but we will see the perfect development of a trend line. And look at this. We can see this here very, very nicely. If we drew our lines across, we can see the lower lows, the lower highs, and that. And so we can identify these. Now, by using a simple moving average line, sometimes it will help you see whether a trend is developing, because a moving average will simply take the noise out of the markets. It won't tell you have higher highs and higher lows and how well developed it is, but you'll be able to see that you do have a trend in pricing. I just want to get my markings up here for a second. Okay. So in other words, there is some driving conviction behind the price action which allows the trader to easily identify it visually. Depending on the type of trend, that is an uptrend or downtrend, successive highs and lows should constitute a rise or falling pattern with relatively few irregularities. But such a case is often a rarity, and the traders will have to back his technical patterns with conviction that can perhaps only be gained through fundamental analysis. Now, if a trend can be visually identified, why would we use technical analysis tools? So even though we can notice the existence of a trend, we still need technical tools to trade it and time it. So let's go over to some real charts and see if we can identify an asset that is trading on a trend. So hold on, let me pop these up here for you. Now, this is a 1 hour chart on the pound. It's just up here because I had it up here for other reasons. But look at that. If we would have looked at this point, or at this point, we had a very beautiful downtrend here. Here we had a very nice uptrend. Well defined. Push, ease, push, ease, push, ease, push, ease. Okay. If we could have identified that, we could have taken advantage to trade it. Okay. This was a well-deformed downtrend. Now this is a 1 hour chart, so this went on from the 27th of November till it ended today. Okay, so that gives you ample time to trade it. But if we look at, let me get some of this markings off of here. Now, if we look at gold, it's got really no defined trend, does it? Now, we're looking at this in a 15-minute chart. So if you're a short-term trading, you'd want it in a 15-minute chart. But even in the 1 hour chart, we can see that gold had some movement, but right now it's trading in a more or less congested fashion. So we have nothing to look at in gold. Because with trend trading, you want to just find the asset. Now, here we go. This is light sweet crude oil on a 60-minute chart. And look at that. We can see a very strong upward movement over a few-day period of time. Now, do we have a well-constructed trend? Push, ease, push, ease. We kind of do. Okay. This movement here was a very long movement, but we have the beginnings of several waves here. So we have this is the lowest point. We went up here and then formed a higher high, formed a higher low, a higher high, and now we're coming back to form the lower high, and we're expecting the price to move back into that pattern. That might help us make a trading decision. Because look at that, it's perfectly timed, perfectly moving. You might want to enter crude oil somewhere around here at the $54 range. So you're less concerned with the asset and more concerned with finding the pattern when you're looking for trend trading. Now, here we have the pound, and this is a beautiful uptrend. Push, ease, push, ease, push, ease. Here we have 1, 2, 3 waves, and we could have entered this market when it turned around and pushed here. The thing is, when it came back down to ease and broke through that trend line, we would have wanted to get out of that market relatively quickly. So if we would have gotten in at this point and gotten out here, we wouldn't have made any money. Doesn't guarantee you're always going to make money. Because we can never predict where the top of that will be and where the reversal will be. If we saw the reversal happening, we could have gotten out earlier. But this was a very steep uptrend. And sometimes when they're hardcore, hard-moving uptrends, they're difficult to find entry points. Okay. So let's go back. Now that we've seen the different types of trends and how they are in reality, let's go back to my PowerPoint for a minute. So using technical indicators that help predict trend reversals or overbought and oversold conditions can help us to identify trends. So here we see Euro US dollar in a 4-hour chart, and the asset was falling down lower and lower here. We wanted to see when the market was reversing and moving into an uptrend by using what's called divergence, which means we were forming lower low and lower low here, or the price pattern was actually moving down. But what we got was a lower low and a higher low in the indicator. In other words, the indicator, if we would have drawn a trend line on it, would have been moving up when price was moving in the reverse. And what happens, we got convergence or divergence between the indicator and the actual price movement. This would have told us that we now have a price reversal coming, or the end of this downtrend. And we might have been looking for this to start an uptrend. And then what we want to do is we have the market reversed, and it moved in, forming a higher high, eased back down, higher low, and then moved up to higher high. See how we actually got this very steep reversal. But using trend trading, we couldn't have traded this point here because we haven't seen the full development of a proper trend. But it didn't mean that we couldn't have gotten in here and made money. Now, trending markets tend to make strong moves in the direction of the trend, followed by periods of consolidation or counter trend retrace before the next leg. In other words, the push should be stronger, and then the ease will be less, and this is why we're making higher highs and higher lows. Now, trending markets, tend to make strong moves in the direction of the trend, followed by periods of consolidation or counter trend retracements before the next leg in the direction of the trend. You will notice this pattern happens in almost any trend you find. And this is true. It's continuous. Typically, what happens to many traders is they will make some money during periods of strong directional trend movement, but they will continue to trade as the market takes a breather from the trend and consolidates. It's these periods when traders give up all the gains they just made when the market was moving aggressively. It is not understanding how the market moves. Now, with trend trading, you would want to get in each one of these at each point that you had a thrust and an ease. Whenever you had that price thrust, whether it's down or up, and then starts the easement, you would want to be entering the market. And this means that you could have taken advantage of the long directional move in the direction of the trend. So it was moving down, you would have gotten in here as soon as it started to ease, as soon as it started, to ease, and taking that whole thrust down here. You could have then exited the market, waited for it to do it again, and taken the second trade, done the third trade at the reversal down, and then a fourth trade. And you would have made 4 trades, and you would have made a profit of $5,400. You would have made 67 pips on the first trade, 74, 94, and then 312. Okay. But you would have been exiting the market every time it went into the reversal. So you need to learn to identify the different parts of the trend. This will help you to avoid over trading during the choppy consolidation period and will give you a better chance at profiting when the trend makes a strong move. Here you can see an uptrend market which consists of stronger upward moves followed by periods of consolidation and shallow retracement lower as the uptrend resumes. Okay. Now we have to be able to separate between spurts and moves. We can see that a trending market tends to move in spurts, moving in the direction of the trend and then stalling to take a breath before another leg in that direction of trend. Imagine price is moving up. Buyers are buying and buying and buying and buying. At some point, the buyers need to take a breath. When they take that breath, they haven't made a decision. They're not leaving the market. They're not selling what they had. They're just taking a breath. When they're taking that breath, the prices ease for a second, and create that easement, and then they're back in here full horse. So you might want to use volume to confirm your trends. So we can see now all the trends are obviously not exactly the same, but we do typically see the general pattern described above, a forceful move in the direction of the trend followed by a period of consolidation or retracement. So the easiest way to verify this is volume should confirm the trend. In other words, we can see volume. This is the increased trading going on as it reaches each one of these levels. So push, we have buyers. We should see volume going up. Ease, we'll see ease down because it's the buyers sitting silent. When they start pushing up and price starts pushing up, you know that you're back in the markets again. Okay, so we can start trading with every increase in volume as long as that price trend is doing the same thing. Now, these retraces are when we have the highest potential for a high probability entry within a trend. Often, a market will retrace to approximately the level of its previous swing point before the trend resumes. In an uptrend, these swing points are support, and in downtrends, they are resistance. Look at the first diagram over here on the right, and you'll see what I'm talking about. So let's look at the chart we just looked at before, but see this time with support levels marked on here. So here we have our support and resistance levels drawn onto our trend. This will tell us also another way of confirming when price is easing what prices should bounce off of. Now again, there's no law about this, but this is what we can expect. And this is when we get the bounce off of the support level, that's telling us the ease is over, and it will give us an entry point to the marketplace. So price moved up, hit the ease, came back down, hit the support level, bounced off it. This is the point we want to be entering the market so that we can exit the market here, then re-enter the market here, and then exit the market and re-enter the market there. So the market would typically retrace back to the previous swing point area and then bounce higher, resuming the trend. These are the points where we want to look for price action setups. Market timing never works when one is trying to predict reversal points on a technical basis. However, market timing in the context of a trend with the purpose of picking the counter trend extremes and using them to enter trade is necessary and profitable. And there lies the main principle of a trend following strategy. Recognizing a trend, identifying the counter trend moves, and using them to enter a trade in the direction of the trend. Now remember the old adage in this market, the trend is your friend. In an uptrend, you should only be taking buy positions after the market eases. In downtrends, you should only be taking sell positions. You do not want to take that ease between, because you cannot predict with certainty how far that ease is going to go. And it's also a much smaller movement. So you'll be making a lot more trades for smaller profits and higher risk losses. So you always want to be trading with the trend. Now the best tools for trend following are supplied by moving averages and simple price charts. Moving averages help you see the trend. Bar charts and candlesticks and many others are equally useful if employed with moving averages. It is also possible to use moving average crossovers and a myriad of other developments. But whichever you choose to use, you should ensure that you do not complicate the main aspect of your strategy, which is following the trend. Now, MACD is one of the best indicators to help you with that. It stands for moving average, convergence, and divergence. Now, once a month we have a 1-hour class on MACD. It is my favorite indicator. And it will help you see this and interpret this very, very well. So if you want to trade on a weekly or daily basis, a 100-day moving average will probably be able to capture most of the important trends for you. Now, if you're trading on smaller time ranges, like most of us are trading CFDs and Forex, and we're trading on daily, we should be using less than a 20-day and maybe even a 12 or 10-period moving average. But as you can see here, trends tend to be pretty easy to spot, and trend lines are a different story. Trend lines are very complicated. Okay. But market trends are easy to see, and you can see how nicely they're well developed. Now you can use things like dojis or candlesticks and some things like dojis to predict a market reversal. Hammurabis will help you with it. You can combine your support and resistance levels with your technical indicators, with your candlestick charts and your moving average to see exactly what is happening to make very easy trading decisions. Now remember, making a trading decision isn't all that difficult because it's easy to make a trading decision. It's figuring out where you're going to enter the market, where to put your stop losses, and where to take your take profits. Because just buying something to say it's going to go up, selling something to say it's going to go down, everything eventually goes up and goes down. But you can go broke in the meantime. So this partly depends on the term and nature of your trend following method. A stop loss order can be placed a short distance above or below the trend line, whether it is provided by a moving average or a simple line drawn on your charts. In our opinion, the trend follower should not realize his profits until he has a good reason to do so. The purpose of the strategy is to focus on underlying price dynamics by stripping out volatility and short-term movements. And there is the logic of realizing profits in response to fluctuations, which are irrelevant in the main action of a trend. This trading method involves a risk management component that uses three elements: the number of shares or contracts you hold, the current market price, and the market volatility. Okay. Using risk management is always important. Not every signal and not every trend and not every trade is a good trade. If it doesn't fit your risk management scope and it isn't using proper money management, you shouldn't be making that trade. So one of the first things you look at is one of the first rules of trend following is that price is the main concern. Traders may use other indicators showing where price may go up next or what should be, but the general rules, these should be disregarded. A trader need only be worried about what the market is doing, not what the market might do. The current price and only the price tells you what the market is doing. Money management. Another decisive factor of trend following is not the timing of the trade or the indicator, but rather the decision on how much to trade over the course of the trend. Risk control, cut losses is the rule. This means that during periods of high market volatility, the trading size is reduced. During losing periods, positions are reduced and trade sizes cut back. The main objective is to preserve capital until more positive price trends reappear. Now, too many people want to trade. Trend following is a matter of finding the most well-defined trend or finding when it's about to begin and entering at the right point. Sometimes it's a slow process, finding it, defining it, sitting and watching it. Trend following should be systematic. Price and time are pivotal at all times. This technique is not based on analysis of fundamental supply and demand factors. So, in Forex, bearish and bullish trends are typically equally as violent and potent, whereas in equity markets, we tend to see slower price action in a bull market along with lower volatility. So you have to understand the asset or the market you're trading. But it's amazing. In Forex, you'll see a downtrend come all the way down, and you see the uptrend retrace usually to where the downtrend had began. It's the dynamics of the market. Forex trends tend to be the same in their volatility and price action, whether the trend is up or down. The main reason is because it's one currency against another at any given currency pair, and this results in more balanced price movement. The simple rules presented here are good enough to replicate the performance of many large name trend following hedge funds with precision. But remember, position size is always important. You should have something to filter your trends. Moving averages or combined moving averages, combining a 10 and a 20-day moving average or a 10 and a 50. Entry signals. Enter long positions on a new 50-day high Vice versa for shorts. Depends on what time frame you're trading. But remember, keep calm and follow the trend. The trend is your friend until it ends. So the one line pretty much sums up the quandary that traders are faced with when trading trends. While a bias has been exhibited in the marketplace and may continue, there is no such thing as a surefire trend continuation setup. So when the trend doesn't continue, the trader is often advised to look to mitigate the loss so that a reversal doesn't damage their trading account too badly. In an effort to be as precise as possible, many traders will move down to a lower time frame in an effort to get more detailed look at the move inside the larger time frame. But remember, price action is what dictates everything. Indicators such as MACD or RSI should be secondary support methods, but can help confirm when the trend is moving. An exit on 3 average true range moves against is a good way to exit. RSI and stochastics will give you exit points, tell you when the market is overbought or oversold, but you should always have something that gives you exit signals. But remember, trading a trend following system on a single market or only on a few different markets is suicidal. There may be long periods, even years, where there are simply no trends in any given market or asset class. So like I said, the key is locating the well-defined trends. The key idea is to trade many markets covering all asset classes at the same time. If you fail to do so, this strategy will simply not work. The investment universe you choose will have a much greater impact than tweaking buy and sell rules. So choose wisely. You could choose a broad set of markets and avoid too high concentration in a single sector. And that's the nice thing about trading CFDs. They give you access to many, many markets. So trends develop for a reason, perhaps due to a shift in the economy's fundamentals. Trends show a bias that has existed on charts. While the future is opaque and unpredictable, this bias may continue. And that is why so many traders look to trade the trends. After all, the future is unknown and nobody has a crystal ball that will magically foretell tomorrow's price movement. But the fact of the matter is that biases do exist. Trends do take place for a reason, and in many cases, these trends may continue. Types of strategies are endless. So here's a simple process that we can use. The simplest trend following strategy uses moving averages. The variations which can exhibit are many. So you simply use your moving averages and calculate them along with your where they have overlaps, and use one for a longer period and a shorter period, and see where the trend is moving. And when you have those overlaps, you should be getting the trend, the market push and thrust. They should overlap in one way when the market's pushing and overlap in the opposite way when they're thrusting. But moving averages can be very, very helpful, because if you trade just using moving averages and trend forecasting, you could produce on the right assets steady income over a period of time. But you have to do your testing and your research. You have to come up with how you would do it. You want to own it, keep it simple, and get it done. And you'd be surprised how easy it is to develop your own trend trading strategy. Once you understand how trends work and what they're doing, most of it's visual from that point on, and looking for that well-defined trend, not just accepting trends, looking for the best well-defined trend. And when you find one, then trade it. You'll be surprised how simple it is. So it's up to you to master this. So thank you very much. We'll talk to you again real soon. Thank you for being part of ETX. And don't forget, we've added Bitcoin to the platform. Bitcoin has been working very well with trending. So keep an eye on Bitcoin, and maybe you want to add that to your trading portfolio. Good night now.